Welcome back to this lecture series titled A Brief History of Money, Banking, and Credit. I am Edward J. Dodson. This is lecture 6, the final lecture in the series titled Globalization, Sovereign Money, and Public Banks. The Emergency Economic Stabilization Act, passed in October of 2008, made $700 billion available to the U.S. Treasury to acquire troubled assets, primarily bank shares and mortgage-backed securities. American International Group, Bank of America, Citigroup, J.P. Morgan, General Motors, and other companies received $426.4 billion, all of which was eventually recovered with a profit to the government of $15 billion. As the financial and economic crisis unfolded, University of California economics professor Mason Gaffney offered readers of the American Journal of Economics and Sociology his analysis of the reasons why mainstream economists failed to recognize the signs of trouble. Importantly, he identified the necessary reforms he describes as, quote, a new framework for macroeconomics. Gaffney's analysis deserves serious study and consideration. He begins by describing the problem with economics. Most forms of macroeconomics today, whether Keynesian or monetarist, presuppose that problems of economic instability can be treated as errors in financial management. Neither fiscal nor monetary policy recognizes the existence of systemic faults in the real economy that result in overinvestment in durable capital that turns over slowly, in contrast to forms of capital that interact more frequently with land and labor. Only by removing serious distortions in microeconomic relations can macroeconomic problems be resolved. The current global economic crisis exemplifies the limitations of policies that ignore distortions in the rate of turnover of investment capital. Time does not permit an examination of the systemic reforms identified in the 94-page article. What Gaffney understood better than most members of his discipline was the operation of land markets and the distortions caused by the failure to publicly capture land rents. I have made the full article available in the online library of the School of Cooperative Individualism. As with the contributions of many thoughtful and reform-minded analysts, Gaffney's contributions await future attention by the members of his discipline and, potentially, by those who hold positions of decision-making authority in the halls of government. This volume here of selected writings by Gaffney, published in November of 2009, includes the above referenced article and others presenting what I find to be well-reasoned argument. In the United States, the most important legislative response to the crisis was passage in July of 2010 of the Dodd-Frank Act, which attempted to set more rigorous standards in the securities and financial trading markets. A key feature involved improved regulation of credit rating agencies and the asset-backed securitization process. A new council comprised of staff from Treasury, the Federal Reserve, and many other government bodies was appointed to monitor the nation's largest financial institutions and was empowered to take action if an institution presented a risk to economic stability. When IMF Managing Director Christine Lagarde spoke in the United States on the 3rd of April 2012, she stated the obvious. More generally, we also need a stronger and safer financial sector that puts societal interest ahead of its own financial gain. This means better and more coordinated regulation. We've come some distance here. The nations of the world, including the United States, have joined forces to strengthen global regulatory standards for banks through the Basel III process. We now need effective implementation in a coordinated manner of what has been agreed and more agreement on the outstanding areas. including regulation of derivatives and the shadow banking system, and effective resolution of banks with cross-border operations. All around the globe, governments have held hearing after hearing on the causes of the 2008 global financial and economic crisis. New regulations and systems of governmental oversight were implemented, resulting in the shrinking in size of some of the world's largest banks, as indicated in this chart. Note the growth rates in the size of the 3 Chinese banks included in the list. What few analysts and policymakers have grasped is the intimate connection between the cascading global economic collapse and the dysfunctional nature of property markets characterized by intense speculation, issues addressed by Professor Gaffney. Easy credit provided by bankers fueled these speculation-driven fires. Deregulation that began in the late 1970s, rather than achieving risk diversification for the banks, lured them into business areas in which they had no management expertise. To protect the bankers from themselves and from land market risks, Mason Gaffney provided one important change in the powers granted to banks. He said banks should be regulated away from lending on land collateral. To take Professor Gaffney's advice, one immediate banking reform that could be implemented is to prohibit any financial institution that accepts government-insured deposits from extending credit for the purchase of land or acceptance of land as collateral for borrowing. This one measure could significantly dampen the speculative character of property markets while protecting bankers from their own failed risk management practices and the taxpayers from the bankers. Which brings us back to the full reserve deposit bank model of the original Bank of Amsterdam. It is worth considering whether publicly owned deposit banks chartered by the world's main trading nations, each issuing coinage of the same weight and content of gold or silver, could mitigate the repeated financial crises that have characterized the last few centuries. Minting of gold and silver into a globally standard coinage as backing for receipt money is certainly a better use of these precious metals than holding bullion in vaults for no particular reason. Actually, the U.S. Constitution permits states to make, quote, gold and silver coin a tender in payment of debts. In 2011, the state of Utah passed a legal tender act to allow their use. Legislators in several other states have introduced enabling legislation. So far, the experiment has attracted little attention or changed the way people engage in and pay for the purchase of goods and services. So far. The most recent innovation designed to liberate the supply of money from the control of central banks and from the expansion of money in circulation by what the central bankers have creatively called quantitative easing is the development of cryptocurrencies, the first issuance of which was called Bitcoin. The question many observers have is whether this new innovation represents a legitimate medium of exchange or is merely one more Ponzi scheme enriching speculators and the system creators. A cryptocurrency is essentially a peer-to-peer electronic cash system. There are no intermediaries such as banks tracking the movement of bitcoins as they are exchanged for goods or services. Individuals or businesses enter the cryptocurrency environment by using their computers to validate and timestamp transactions, adding them to a form of ledger referred to as a blockchain. At the time the cryptocurrency is established, a cap is established on the number of bitcoins that will be available. The verification work performed earned participants ownership of bitcoins or a portion thereof. The key to the system's value is the software that ensures that all transactions are recorded, verified, and cannot be modified once entered. Thus, once a party spends a quantity of Bitcoin, its account is automatically reduced and the other party's account increased. Transactions are therefore essentially instantaneous. The system eliminates the use of credit. The limited supply of bitcoins in the system means that as the number of participants increase, the exchange value of each bitcoin has tended to increase. Thus, competition in the transaction validation process has caused the introduction of more and more powerful computers to run complex algorithms in an attempt to earn even small fractions of the original bitcoins. The first bitcoins became publicly available in 2009. Slowly at first, participants got involved in producing or, quote, mining bitcoins. The price of a bitcoin has been volatile since its introduction, reaching a high of almost $69,000 in November of 2021. As of April 2024, the price was around $63,000. Major concerns have developed over the amount of electrical power required to run these computers, which has resulted in the development of new forms of cryptocurrencies where each account controls its own transactions and no verifications by others are required. Today, Iceland is the center of cryptocurrency mining in part because of its low-cost electricity. The government in Iceland has already become concerned that the amount of electrical power used to mine cryptocurrency has surpassed that used to power all of the residential properties in the country. An analysis by Robert D. Knight explains the current challenges. Like all the world, we've been making subsidies for imports of electric vehicles, so the demand for electricity has gone up. Development of new power plants has been minimal due to regulatory constraints, and today the market is in many ways fully tapped, with periods of energy shortages. A fundamental question is whether that portion of the economy engaged in financial transactions adds to the production of actual wealth or merely results in its redistribution. Is there a loser for every winner? The public has come to see there are few winners and many losers. Since the 2008 crash occurred, a small group of economists and financial reformers have tried to stimulate meaningful debate over whether the issuance of currency should be made the responsibility of government, fully privatized as in the era of free banking, or simply requires more rigorous regulatory oversight. As nations struggled to recover from the 2008 financial crisis, governments enacted financial reforms designed to provide greater transparency of transactions and reduce the risks associated with investment in derivatives and other exotic financial instruments. The European Union issued in June of 2011 the Alternative Investment Fund Managers Directive, establishing common requirements governing the authorization, operations, and supervision of AIFs. New rules were adopted in September 2016 to govern non-centrally cleared over-the-counter derivatives. These margin rules were published by the Basel Committee on Banking Supervision. The objective is to ensure appropriate collateral is available to offset losses caused by the default of a counterparty. As mentioned, in the United States, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act with the hope of reducing systemic risk, increasing transparency, and promoting market integrity. Again, the target was the over-the-counter derivatives market. Banks were subjected to what has been called the Volcker Rule to prevent risky trading associated with ownership and investment in hedge funds or private equity funds. Stephen Zarlenga, who founded the American Monetary Institute in 1996, extensively researched the history of money and banking and credit. In a speech he delivered in 2004, he placed much of the blame for our unstable monetary structure on the economics discipline. He states, "One reason economists have failed mankind so badly is their poor methodology, an over-reliance on theoretical reasoning. Alexander Del Mar, the world's greatest monetary historian, noted, "As a rule, economists don't take the trouble to study the history of money. It is much easier to imagine it and to deduce the principles of this imaginary knowledge." Stephen Zarlenga believed we should implement the following reforms. 1. Nationalize the Federal Reserve System. 2. Reconstitute the Fed within the U.S. Treasury to become a fourth branch of government. And 3. Restrict the creation of money to the federal government. At the opposite end of the reform spectrum is the proposal to permit free banking. Any banking entity could issue its own banknotes. Market forces would be relied upon to control the supply of banknotes and the quantity of reserves required to meet demands for cash by depositors. Reserves would be in the form of gold, silver, or possibly other scarce commodities with a stable value. Fred Foldvari, who for many years taught economics at San Jose State University, believed free banking would work very efficiently and with little corruption. He wrote as follows: "The artificial increase in money supply can be halted permanently by implementing free banking. Without a central bank and a national currency imposed upon the economy, inflation of the money supply beyond the growth of the economy is no longer feasible, since there is no longer a monopoly of the money supply." A somewhat different approach has been advocated by the Center for Economic and Social Justice, a Washington, D.C. based organization founded by Norman Kurland, who was a longtime associate and collaborator with Louis Kelso, the person most responsible for legislation creating employee stock ownership plans. What Kurland and his allies seek is a society where every person derives income from the ownership of shares of stock. To make this a reality, his organization has lobbied for passage of a Capital Homestead Act. As described by Kurland, the Capital Homestead Act's central focus is the democratization of capital productive credit. By universalizing citizen access to direct capital ownership through access to interest-free productive credit, it would close the power and opportunity gap between today's haves and have-nots, without taking away property from today's owners. In 2008, the President of the United Nations General Assembly convened an international panel of financial experts, chaired by economist Joseph Stiglitz, to analyze the causes of the crisis and offer measures to stabilize the global economy. Late in 2009, the Stiglitz report was released. Their conclusion? The crisis is not just a once-in-a-century accident, something that just happened to the economy, something that could not be anticipated, let alone avoided. We believe that, to the contrary, the crisis is man-made. It was the result of mistakes by the private sector and misguided and failed policies of the public. Reforms over the past 3 decades have exposed countries to greater instability and reduced the impact of automatic stabilizers. The crisis is, in part, a result of excessive deregulation of financial markets. Restoring the global economy to health will require restoring to the state the appropriate role of regulator of financial markets. Analyzing the financial instability associated with the structure of the U.S. banking sector, attorney Ellen Brown began to write in support of establishing a nationwide system of public banks modeled on the Bank of North Dakota. Her first book on the subject, Web of Debt: The Shocking Truth About Our Money System and How We Can Break Free, was published in 2007. In 2011, she founded the Public Banking Institute. She describes the virtues of the public bank option as follows. Our current private banking system has presided over the greatest concentration of wealth in human history, while the vast majority of America and the world has endured stagnant wages, declining wealth, and recurring recessions. In contrast, public banks empower small businesses, students, homeowners, city and state governments, and community banks to prosper and thrive by banking for the common good over the long term and making low-cost credit available where it is needed in the real economy. Brown has since written 2 more books on the subject in an effort to generate broad public interest and support for the public banking alternative. In March of 2021, she reported on the progress being made for legislation to establish public banks. Just over 2 months into the new year, 2021 has already seen a flurry of public banking activity. 16 new bills to form publicly owned banks or facilitate their formation were introduced in 8 U.S. states in January and February. 2 bills for a state-owned bank were introduced in New Mexico, 2 in Massachusetts, 2 in New York, 1 each in Oregon and Hawaii, and Washington State's public bank bill was reintroduced as a substitution. Bills for city-owned banks were introduced in Philadelphia and San Francisco, and bills facilitating the formation of public banks or for a feasibility study were introduced in New York, Oregon, 3 bills, and Hawaii. Many structural problems remain. For example, the European Union tried to create a single monetary and banking system without any significant influence over the systems of taxation and budgeting of member states. Portugal, Italy, Ireland, Greece, and Spain required intervention by the European Central Bank and the International Monetary Fund in order to restructure government debt and work out problems with their own distressed banks. In 2016, British economic analyst Fred Harrison teamed up with Mason Gaffney on this book analyzing what the UK needed to do to avoid a post-Brexit contraction in the nation's economy. Harrison summarized their conclusions in the spring 2021 issue of the publication Land and Liberty. He wrote, "The UK is now free to chart a new course, if it can retrieve the thinking that informed its governments in the early part of the 20th century. Back then, 2 budgets, in 1910 and 1931, did attempt to lay new financial foundations. In essence, the plan was to shift the fiscal burden off people who added value to the nation's wealth by funding public services out of the unearned revenue that accrued to the owners of rent-yielding assets. Those initiatives failed because the free riders, economists call them rent seekers, exercised the power to block the legislation. Back then, the rent seekers were numerically in a minority and ensconced in the House of Lords. Today, however, land-owning families are in the vast majority, the homeowners of the UK. Their plots of land are modest, but they capture rents from those sites. If they chose to view the UK's prospects from the moral perspective, as well as the economic prospects for their children, they could mandate the revision to the way governments raise revenue. In 2018, the Congress passed the Economic Growth, Regulatory Relief, and Consumer Protection Act. Regulatory requirements under Dodd-Frank were removed for all banks with assets less than $250 million. A global financial development report issued in 2019 by the World Bank concluded that while large banks had shifted their assets into categories that have lower risk weights, there are surely hidden risks so that the numbers may be providing a false sense of security. The collapses of Silicon Valley Bank and Signature Bank in 2023 were the second and third largest bank failures in U.S. history. 3 more bank failures followed: First Republic Bank, Heartland Tri-State Bank, and Citizens Bank of Sac City. First Republic Bank was larger than Silicon Valley Bank. As of this writing, only 1 more bank failure has occurred in 2024, Republic First Bank. However, most of these failures involve banks with assets of over $100 billion. Serving wealthy customers, the majority of deposits were uninsured. Many nations have been pulled into uncharted financial territory, none more so than the United States. The law governing the Federal Reserve permits the central bank to create monetary balances at will, balances which are then loaned to the federal government at interest. If the government securities are then sold to investors, there is no increase in the net money supply, merely a shift from private to public spending. If the securities are held by the Federal Reserve, the money supply is expanded until the securities are sold. This chart shows the rough ownership of U.S. debt in 2023. Spending continues to far outpace the receipt by the federal government of revenue from taxation and other sources. Servicing the public debt of $34 trillion is an enormous challenge to economic stability. The publication in 2020 of Professor Stephanie Kelton's book, The Deficit Myth, has stimulated considerable discussion and debate over logic behind the way central bank created money is created out of thin air, then used to invest in government securities. In the U.S., the Treasury at one time issued the nation's paper currency. Why not return this responsibility to the Treasury, the money allocated to government departments to be spent into the economy? Additionally, the Federal Reserve could, as outstanding securities matured, create enough new money to go into the credit markets and purchase all government securities put on the market by private holders of the debt. This would expand the money supply by putting cash into the hands of those who now hold government securities. This cash would then be deposited in banks to be recycled, invested in corporate shares, invested in corporate or non-federal government bonds, or spent on consumption goods. As Stephanie Kelton and others argue, governments can, within constraints designed to prevent inflation, simply create and spend money directly into the economy. The issue for us as citizens is whether we have more or less trust in those who now create our money, or those in the Treasury or elsewhere in government who would create our money. Another characteristic of our system of money, banking, and credit is that banks do not really need to have cash assets in order to make loans to individuals, businesses, or other entities. The loans magically create the money themselves. How is this possible? All national banks must be a member of the Federal Reserve System. State-chartered banks that meet certain requirements may join. A portion of the member bank's assets are held as reserves by the Federal Reserve Bank in their district. This actually permits the bank to extend loans up to a multiple of these reserves without actually having the cash on hand to do so. If the banks operated simply as an intermediary, their lending activity would be dictated by how much cash the bank had on hand to loan to others, subject to reserves held to protect the bank against losses should borrowers default. The question then is whether this is a change that would lead to improved stability in the banking sector. Let's look at what happens when a bank is formed. Its owners invest cash, which is the bank's initial financial capital. The bank may also issue bonds to raise additional cash. These are the funds used to set up the bank. When it opens for business, the bank invites individuals and businesses to establish checking or savings accounts, depositing cash with the bank, a portion of which the bank can use to make loans. For the services the bank provides, fees are charged to its customers. By incorporating, the bank could raise additional cash by selling shares of stock to the public. Although the way our money is now created and how banks operate and are regulated continues to raise concerns and calls for further reform, the likelihood of returning money creation to the government and limiting bank lending to whatever cash can be raised as just described is unlikely, at least until we experience the next financial crisis. Nor is it likely that paper currency or digital money balances on a computer will ever again be redeemable in a specified good or basket of goods. Of course, there is still the remnant structure forged at the Bretton Woods Conference. The International Monetary Fund's charter permits the issuance to member countries of what are called special drawing rights, or SDRs. These SDRs are distributed to all members in proportion to their shareholdings in the fund, with no conditions attached. The original purpose of SDRs was to replace the US dollar as the global safe harbor of currencies, as the value of the US dollar declined against gold. However, despite stagflation, followed by the recession of the early 1980s, the US dollar maintained its position among national currencies, and SDRs were little used until the global financial crisis occurred in 2008. The cost of fighting the COVID-19 pandemic ignited pressure on the International Monetary Fund to provide financial assistance to many countries. Since the IMF's dollar assets are limited, the solution advanced is to issue these SDRs. SDRs could then be exchanged for needed sovereign currencies by IMF member countries. In terms of permanent systemic change, the head of China's central bank has called for the world's trading partners to replace the US dollar as an international reserve currency with SDRs. The government of the Bank of China is calling for a reserve currency that will be disconnected from economic conditions and sovereign interests of a single country. U.S. Secretary of the Treasury Janet Yellen has supported increasing the allocation of SDRs in a letter to the IMF as a strategy to provide liquidity to financially poor countries. And there is some support in the U.S. Congress for the IMF taking this action. Secretary Yellen stated, "Without further international action to support low-income countries, we risk a dangerous and permanent divergence in the global economy. An allocation of new special drawing rights at the IMF could enhance liquidity for low-income countries to facilitate their much-needed health and economy recovery efforts." Since 2020, the IMF has channeled $55 billion to the IMF's Poverty Reduction and Growth Trust. So far, these loans have been distributed to 56 countries. And so, the people of the world await either reform or the next financial crisis. And with that, we've reached the end of Lecture 6 and the end of this course. Thank you.